Good morning, everybody. Welcome to the Finance Audit Committee meeting of the CHFA Board of Directors. My name is Hazim Taib. I am the Chief Financial Officer. This meeting is being audio recorded. Please identify yourself before speaking. We will start a roll call of the Finance Audit Committee members. Jerry Abrams.
Here.
Tim Hodges.
Here.
Kathy McKinnon.
Here.
Josh Perez.
Here.
Sarah Sanders.
Here.
Jared Smith.
Here.
Franklin Perry. Glenda Wynne-Thames. So, Jared, we have 6 on the call and 2 absent as of now. So, Jared, do you want to?
Yes, I'm sorry. I was on mute there for a second.
That's fine.
So I'll just officially convene the meeting for May 28th and have staff start going through the reports.
Sure. Good morning. Okay, Allison, do you want to start with the financial reports?
Yes, I'd be happy to. Before you should have the April monthly, financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in $3.2 million below budget and $1.3 million lower than prior year. Revenue shortfalls are largely a result of the decrease in our single-family production. The amount of single-family first mortgages originated during the period of January through April of this year are $62.3 million lower than the same time last year. Additionally, single-family loan prepayments have increased by $17 million over the same 4-month period. The net effect of the reduction in single-family loan originations and increase in loan prepayments is a portfolio reduction of $79.3 million. I'm sure both John or Sherry can probably go into this in a little bit more detail when they go through their reports. On the expense side, bond interest expense is below budget by $4.9 million. And, is $2.4 million lower than last year. The variances are basically being caused by 2 things. One of them is the amortization of original issue bond premiums, which was on last month's memo. I won't go into that again. And the fact that outstanding bonds payable are $199 million lower than the same time last year. On the administrative expense side, we're coming in $2.2 million under budget and $264,000 less than prior year. When you exclude salaries and bennies, or $8.5 million, our current year-to-date expenses are $404,000 lower than last year's. So as you might imagine, the authority has incurred some expenses related to COVID. We have incurred some minor costs to purchase PPE, face masks, gloves. We've also done some additional cleaning of the building during the last couple months. Also, the vast majority of employees have been issued laptops to enable everyone to telework during this time. Enhancements had to be made to our VPN connection to accommodate all the users on it at once. So you'll see the majority of those costs related to the IT expenses, which are the vast majority of it, would be under the information systems operating and capital budget line items. And that's about $137,000 as of this point. Are there any questions?
So there's a few things.
I have one.
Oh, go ahead.
When you say that we incur COVID expenses and you mentioned the laptops, is that really COVID related, or is that part of the agreement we reached with the unions that we're all supposed to be buying laptops for our employees and giving them all the options to telework.
We're actually not a union shop, so it's more based on the governor's directive to, stay safe, stay home directive. So
CHFA did not have to comply with the same thing that every other quasi and every other.
I mean, we wanted to comply with the directive, most certainly, but we don't.
So you're saying to me that this is strictly to do with COVID-19?
Yeah, I don't think we would have been
going to implement telework. We were never going to. If COVID-19 never happened, we were not going to implement that teleworking initiative that we agreed to do. We, meaning the state, not necessarily CHFA now.
I don't believe.
Yeah.
Go ahead, Nancy.
Yeah. So we were looking into establishing some type of a telework. We did not have any policy regarding telework. We only had, I think, if I'm not mistaken, like only 10 laptops available, and that was more because of for asset managers when they go out or some emergency presentation, so on and so forth. So we didn't really have the inventory and the infrastructure to support telework.
Right, which most agencies didn't either. They had to build it into their budget as time went on. Anyway, the only reason I'm asking is because obviously if it's directly related to COVID-19, I know OPM has put out some directives to keep track of that, and hopefully we're going to get reimbursed 75% or so from the federal government. But on the other hand, we got to be careful we're not including stuff there that we would have spent normally, if I'm making sense.
Yes. If our expense is eligible, for sure we would put forth a request for reimbursement. But yeah, one of the things what we just want to inform the committee was the expense that we had to incur relating to COVID.
Right, no, but since I heard the word we bought laptops to allow people to telework, that's why I asked the question, to make sure that in my mind, I clearly understand. Was that really a COVID-19 expense, or that was, like for instance, in my budget, in my agency, right, there was money allocated so I could start buying laptops. And I would have bought that whether COVID-19 happened or not, right, because that was the strategy, right, that we were going to buy laptops on an annual basis for everybody, and everybody had one, right, and then we do refreshes because of the kind of work we do. So technically, the money I spend on whatever number of laptops we bought this year, right? Let's assume it was 20, right? That's really not COVID-19 because that was already my budget. It was already geared to buy in order to meet another initiative,
So if I understand correctly, there was no money built into this current fiscal year budget to account for going to telework. Is that accurate?
That is accurate.
Yeah. Mm-hmm. That is accurate.
It was really only the pandemic that caused us to spend that money.
Correct.
Right.
Right. You answered my question. That's what I was trying to get at.
Okay.
So then the only other thing that I just want to add, and John and Sherry, they are going to elaborate, when it comes to the revenue side, interest on loans, interest on investment, we are definitely seeing a slowdown year over year. So that definitely has a corresponding effect. But then at the same time, on the bond side, because while it's not linear, since we are not producing as many or making as many loans, we are not also increasing our bonds payable.
I have a follow-up question about the single family. So the drop-off in single family compared to last year, what is that that dollar amount? What is that as a percentage of what it was last year? Do you know that?
From a reservation side, we are about year-to-date about 43% less year over year.
Okay.
And from a purchasing side, we are about 33% less.
Okay. And what do you anticipate over the next, let's say 3 months? Is this going to start ramping up at this point, or do you see it continuing at this pace for a while?
It's probably going, Connecticut's market is interesting. When pre-COVID, but still this year, one of the things that we were facing was the lack of housing inventory. But then as interest rate came lower, there was a slew of, you had the refinancing boom. And we actually heard from our lenders, because we were curious for whatever reason, we saw the drop in reservation or the new loan flow. Some lenders were essentially putting new loans, originating new loans in the back burner, and they were focusing more on supporting the refi shop and the refi business. And some of them actually even artificially increased the rate because they were having a tough time keeping up with demand. They were hiring temps. So this is pre-COVID, like pre-March, like between January and it's probably late February. But then when COVID happened, as everybody know, the whole thing about the stay-at-home, it just caused that there is that ripple effect. But what we did hear, at least for the last few weeks, after the CARES Act was passed, there was this trepidation by lenders to originate first-time homebuyer loans because of the ability of a homeowner to seek forbearance or, payment relief. So they were concerned that originating HFA loans will take longer. Therefore, the lender would be on the hook if in an event that the home buyer seek forbearance because they are permitted by federal law. So you have all that dynamics. So we hope that within the next few months that there will be a bit more clarity. We've been working with lenders trying to streamline the closing process to ensure that our originators, they are being, how should I say, having the proper coverage in terms of originating the loan, but not being settled by a loan that cannot be serviced because the loan is in forbearance. So we're trying to work with our lenders and our services on that manner.
Yeah. I will add to that too that they have changed the underwriting criteria. They're requiring a higher credit score. They're also requiring a lower LTV. So basically, for someone, and this is a guesstimate on my part, for someone to get a mortgage in the next 2 to 3 months, it'll be much more difficult than it was 3 months ago. Because what the lenders have reacted is, we're only going to make loans that we feel much more comfortable that they're going to have the ability to pay without asking for forbearance. So that's, like before you could get a loan, not easy per se. If you had a credit score 645, 680, now they're asking for 700 a credit score, right? And before they would do 90, 95% financing in some cases. Now they're asking for only LTVs of 80%. So I expect that from traditional, meaning conventional mortgages, it's going to be much more harder for people to get a loan. And also Connecticut economy is more service-oriented. And if you look at the unemployment numbers, they're extremely super heavy on the service industry, meaning restaurants, barbershops, hotels. And those jobs don't appear they're going to come back in big numbers right away. And in some cases, it is estimated that about 35 to 40% of those jobs will not come back at all. I've seen reports on that from economists. So we really need to start looking at that because that may affect our operations for at least a couple of years.
Wow.
You can't have all the numbers of restaurants and stuff like that, and especially national chains that have actually declared bankruptcy, and even if they come out of bankruptcy, they're going to be, 0.5%, 3/4, in some cases less of a presence, and not expect that those jobs are not going to go away, right? Because if you were a chain and you had, I'm making up the numbers now, right? 1,000 restaurants, you declare bankruptcy, and when you come out of it, you only have 250. Well, that's 750 restaurants that are not going to come back, and you multiply that by how many employees that each restaurant has, those jobs are not coming back. I mean, the economy will have to retool, right? And some other job hopefully would happen, right? But it's going to take a while.
Hi, this is Kathy. Is this something that will be sort of incorporated into the upcoming strategic planning?
Yes.
So the assessment is that the drop-off in single-family production is not just a timing issue, but rather this is lost demand that isn't going to reappear anytime soon.
The truth is we don't know, right? Because we never had this kind of crisis. This is not like 2008, 2010. You clearly knew what caused the crisis. You clearly knew what we had to do, right?
Right.
So let's assume that tomorrow, magically, this COVID-19 goes away. Well,
right, because the federal uncertainty with respect to another round of stimulus is adds to not knowing really how it's going to, what impact it's going to have.
That's also another unknown. But those federal stimulus are only going to last for so long, no matter how many of them they do, right? Because at some point, I mean, the federal government has already run out of money, but they print money. But at some point, the reality is going to hit and say, there's only so much money we could print, right? Before we create a bigger problem.
Borrow it. To borrow it. Yeah. No, I agree, yeah. It's going to run out, you're right. It's temporary.
And also, every state economy is somewhat different, right? And the more that your service economy, meaning restaurants, hotels, tourism, the harder you're going to get hit. About the only other industry that's going to get hit as hard, if not worse, will be the energy industry. But that one, the expected will rebound. Because once people start driving again, gas only will go up again.
So I think it's safe to say this is a complex issue, and we can probably talk more about it during the strategic planning and get some more details and probably have a better idea of what we can expect in the future, and try to figure out then how we're going to address it.
I agree, and also how it's going to impact our own staff, right? Our own operations.
That's right.
So we have to reassign people somewhere else, because even though the new originations may go down, right, loan workout at some point is going to become bigger, right? Because at some point the forbearance has to be dealt with, right? And some of those are never going to be able to, on the short term, be able to come up with a plan of paying back, right? If the jobs don't come back.
I think you're right, Commissioner.
Unfortunately, you're right. And that's what I'm seeing with the banks, and based on the kind of the different webinars I've gone to, where you get all those economists who are supposed to be much more smarter than I ever will be, doing analysis.
Yeah. All right. Any other questions there? All right.
Okay. So before I hand it off to John, just want to check. Franklin Berry, are you on the call? Gwendolyn Thames, are you on the call?
Hazim, I know Franklin's on. He texted me, or at least he was on. I told him that if he's not able to talk, that he should log in as a host. But I'm pretty sure he is on.
Okay.
Hazim, why don't you just give them that number again, so that they can, if they don't have their stuff on them, maybe you can just give them the host number.
Yeah, I can't give the host number on the call because we do have, because this is open to the public.
Thank you.
Okay, John?
Okay. For the month of April, the authority purchased 121 loans totaling $21.3 million, of which 114 loans totaling $19.8 million were securitized, or 94% of production. The remaining 7 loans totaling $1.5 million were whole loans, and the average loan of both types of loan was $176,000. The April month-end mortgage-backed security balance was $2.45 billion, an increase of $5 million from the prior month, while the whole loan portfolio through the end of March declined by 70 loans, or $4.6 million net, with a total portfolio balance of $1.6 billion. The overall delinquency rate month over month decreased by 30 basis points to 2.61%. The carrying balance for loans in foreclosures year over year decreased by $11.3 million to $39 million, while the total number of loans in foreclosure decreased by 90. For the month of April, the authority funded 44 down payment assistance loans totaling $267,000 with an average of $6,062 per borrower. Approximately 36% of CHFA borrowers utilized the down payment assistance loans with their home purchase. Forbearances. Through the end of March, we had 96 whole loan borrowers with a UPB of $11.6 million requesting, and they received a forbearance for the March payment. For the month of April, the number increased by 661 to 757 whole loan borrowers with a UPB balance of $93 million, or approximately 5.3% of our overall portfolio received forbearance for the April payment. The average loan size of loans in forbearance was $123,000, which is just a little larger than our overall whole loan balance average. Well, the majority of the homeowners received a 3-month mortgage payment relief. And according to the Mortgage Bankers Association nationally, it was 8.2% of borrowers were in active forbearance plans as of their May 10th survey. And our multifamily side, for the month of April, the authority did not close any new loans. The portfolio remained at 547 loans with a balance of $1.24 billion. Permanent loan delinquencies remained at 3 loans. Construction loan delinquencies increased by 1 loan to 2 loans, with a combined delinquency rate of 1.86%. Any questions?
I have a question. I understood what you're saying, and I understand we don't have a crystal ball. But if we start looking at, let's assume that some percentage of those forbearance are going to become workouts, for lack of a better word, meaning that their jobs, it's going to take a while for them to get back, right? And they won't have a job to pay. How that may impact our financials going down the road. Am I making sense?
Yes. So just to put everything
and
into
I realize
context,
we don't have a lot of data on it, but, you know.
Yeah. So the 5.3% being referenced based on an average of 3 months forbearance, that will cost us about $1.3 million. So if that 5.3% rise to 8.5%, the amount is about $2.1 million, and if it's 10%, it's $2.4 million. So say that.
Yeah, but if you could put that in writing, because there's no way I'm going to remember this.
Right. No. But so that's why I just want to use simple numbers. So if it's 10%, assuming that each of those 10% borrowers receive 3 months worth of forbearance, is going to be about $2.4 million. So that will be the amount of the workout that Commissioner, you're referencing.
Yeah, and I also would like us to look at the portfolio, right? Like, for instance, if some of those numbers are people who aren't nurses, right? And people may be surprised to hear this. Nurses got laid off, right? But the type of nurses that got laid off were not the ones that worked in the emergency room, not the ones that did the selective surgeries, right? So for a couple months, there was no selective surgery, so they got laid off. Now they started doing it again, so now they're going back, right? So that part of the portfolio is going to be okay eventually, right? So yes, for 2 months there was forbearance, but there's a plan. There's a light down the tunnel. They're either going to pay it back in full, they're either going to pay refinance, they're either going to do a loan modification, or are we either going to allow them to pay when they refinance or sell their home? So there's a plan. So in that case, all we've done is delay us receiving payment, right? The payment's not going to go away. So that's what I'm saying, that we need to start looking at it. And it may be too early to do today, but it may not be too early to do tomorrow. That's not making sense.
Yeah, that's always been in our plan in terms of our instruction to our services to ensure that when they do talk to, say, in your example, the nurses, the repayment plan will be based on each individual nurses. So we don't have like a one-size-fits-all, because we do understand that every person's financial situation is different.
Right, and how it's going to impact it to be different.
And to address your question earlier about what about the percentage of those jobs that aren't coming back and the impact on our financials, I think the good news scenario on that side is that a large percentage of our loans are insured loans. The majority of loans are in our whole loan portfolio or FHA loans. So in our modifications, we'll be following their guidelines, with the forbearances. But to the extent that there are permanent job losses and ultimately resulting in a home loss, and a majority of those will be insured.
That is great news, and that's why I would like to see if we could start getting a report on a regular basis. Basically giving us those numbers that you went over, but then also giving us some analysis, projections of how it may, if, like Christine says, 20% of that population doesn't pay back, right, because for whatever reason. What does that mean? It doesn't mean that we necessarily lose 100% of that money, because we do have, they are guaranteed, right, or we have insurance.
Yeah,
I would have to start getting, a report on a monthly basis, or if that's too much on hybrid, people deem it to be appropriate. So we could start getting a feel for it. And you're right, I agree. In our case, the impact is not going to be as bad as in those cases where there is no guarantee.
Absolutely, and part of the reason why we included this new category is because we do want to keep the committee informed. What we have in front of us is like impacts on two variables. One is on the financial, one is on the human side. So for the financial, you heard what John said. Majority of our whole loan portfolio is FHA insured. So from an impact to the financial statement is going to be minimal. But then on the human side, we do want to make sure that for those who were impacted by COVID-19, we want to provide them with all and the best kind of system to ensure that they can remain in their homes.
I agree. And all I'm saying is I would like to see that.
Is that something that that staff can produce for us, Hazim? Can you do that on a monthly basis per the commissioner's request? Is that fair? And the amount of detail that he's looking for as far as trying to gauge maybe even the careers that they're in and whether or not the probability of them being able to or not being able to afford their mortgage in the future?
Yes, but we will only know that at the end of the forbearance period, because that's when they are supposed to work with each servicer or their servicer, trying to determine where they are at when it comes to their financial conditions. But we will report and then transmit as much information as we know by month end.
Great.
Okay.
Any other questions there?
Okay, Ed, you want to talk about our investments?
Sure. Good morning. You have in your package the investment report for the first quarter of 2020. The investment report reflects an increase in investments of about $175 million from December 31st to a total of approximately $3.29 billion. The increase is due to continuing purchases of MBS program assets and the buildup of the funds in the debt service accounts as the authority got closer to its semi-annual debt service payment of May 15th. Quarter over quarter, the weighted yield to maturity for the investment portfolio went down to 2.41% from 2.64% due to a decrease in short-term rates. As an example, the STIF rate was about 85 basis points lower at the end of March than it was at the end of December. You also have in your package a report on the authority swap portfolio. The swaps are used to hedge the variable rate bonds to generate a synthetic fixed rate long bond that has a lower cost to the authority than a traditional long-term fixed rate bond. The swap report shows a hedging position of 38 swaps with 9 counterparties totaling $901 million notional amount. The number of swaps, counterparties, and notional is the same as last quarter. Thus, the weighted pay rate by the authority remained the same at 3.281%. The weighted pay rate gives an indication of the weighted average rate the authority pays on the outstanding notional of swaps. The mark-to-market decreased to a negative $221 million from a negative $132 million. The decrease in the mark-to-market of the swaps was due to the sharp decline in interest rates since year-end. Are there any questions?
I assume that, Sherry Abrahams, in all our counterparty agreements, we have no collateral posting requirements at our current rating so that we're indifferent to the change in mark-to-market?
Correct. With one little exception, there's that has a collateral posting at a AAA, but the threshold is extremely high. So, in fact, correct. We don't have any threshold requirements.
So there is one swap where there conceivably you'd have to post, but the threshold's so high that it's not operative?
Correct. It's an old MLCS swap.
This is Sarah. I was wondering how the dislocation between taxables and tax exempts, has that impacted the portfolio of swaps in any way?
No.
I can't. No. I don't see any impact. I'm trying to think, and I don't see an impact yet.
Okay.
Yeah, I think, Sarah, the impact that we saw was because you do have this dislocation. If in any event we would like to procure a STIFMA swap, it will be a bit more expensive than usual.
Mm-hmm.
But then, go ahead.
Well, I just had a follow-on question. I see most of these are LIBOR. Do you have language for when LIBOR goes away? Or I assume you're working on that. I think you've mentioned that before.
Yes. And since you're bringing it up, next month we are going to talk about LIBOR, and this is based on the discussion we had in the prior month.
Okay.
So the only thing I want to add is more for the new members. When it comes to our investments, and this goes back to Allison's report on our income statement, we invest primarily in 2 vehicles. One is on the short-term basis, and we invest with the Treasurer short-term investment funds. We typically use this fund when we receive mortgage payments, and then those payments will sit in the revenue fund before it's being used to pay the bond debt service. So it's primarily just trying to satisfy the requirements of the bond requirements, where the only vehicle that we can invest in would be anything that has a duration that is tied to the next bond debt service payment. The second vehicle is in investing in mortgage-backed securities, which essentially is investing in our own loans, but now those loans are backed by either Ginnie Mae, Fannie Mae, or Freddie Mac. So for the current year, if you look at the report, you can see that as of March 31st, the short-term investment rate was around 80-plus basis points, 86. As of yesterday, it was like 45. So you already have a reduction of about 50 basis point of return, short-term return. And then when it comes to our mortgage-backed securities, generally for 2019, we were securitizing loans on an average rate of 2.98% or close to 3%, but year-to-date is now at 2.46%, a drop of about 50 basis points. So those drops do have a corresponding effect to our investment return.
Okay. Any other questions? All right, monthly tracking.
Sherry?
Hi, this is Sherry Lambert. As you can see in your monthly tracking report, there are 3 projects that you'll be seeing at the board meeting that are both utilizing all 3 are utilizing tax-exempt bonds. In order to do these 3 projects, we did transfer $22.5 million of tax-exempt bonds from our single-family program into our multifamily program, and the remaining funds you can see on the first page are now tax-exempt bonds are at 0. In the home ownership area, we've already talked a little bit about this, that there were 121 first mortgage loans and 44 DAP loans. This is lower than last year at this time. The only thing I would add to this is that this program, our homeownership program, is very closely tied to unemployment, as we've discussed. And in addition to all the things that have already been talked about, the other lag that will happen with this program is even if people can get mortgage assistance during this time, some of their other credit they won't have assistance for. So what will happen coming out of this crisis, as things normalize, a lot of people won't have, their credit will have been hurt during this, and they won't have the credit to then get into new homes and start, the first-time home buying process. So I think our program will probably lag behind recovery from the general economic recovery. Are there any other questions about what's going on in our programs?
Hi, this is Kathy. If there is a lag in the single family, will more funds be transferred to the rental program?
I think Azim can answer that, but I would guess that we'll approach that as it occurs.
Yeah, Kathy, the way we manage our private activity cap is the cap is available for both programs. So one of the things that the benefit the single family has is it has a very big portfolio, and the code allows for previously issued volume cap, upon satisfying certain conditions, it can be used to recycle and for new mortgage loans. So in the case of when we are transferring some of this cap to multifamily, is because we are seeing a need from the multifamily portfolio, and we are trying to address those needs by committing those cap to multifamily. If in an event that we get to year-end where we do not have sufficient cap to satisfy both programs, then what we would do is we will issue taxable bond to fund the single-family program, because for multifamily, it does need the tax-exempt bond cap for the 4% tax credit.
This is George. I think also we have to take into account the fact that a lot of those developers that would do the multifamily, not necessarily the ones that probably deal with us, but the general public one, are very upset at some of the policies. When I say we, I don't mean necessarily Connecticut, we collectively as a nation, around deferment of rents and that kind of stuff. So if you look at the numbers of of permits for multifamily obviously has dropped. And we may want to reach out to the industry to make sure that they got over the initial shock of when if you had a federal mortgage guarantee, you could not evict people. You had to do also deferment for the rent. And then we did the same thing for through executive orders for those who didn't have federal guarantee mortgages but had conventional mortgages. And some of those landlords / developers are saying, well, if you're going to do that, you're going to create a crisis because we'll start building them. And I admit that most of those are not the ones that we normally deal with, right?
Yeah,
there may be an adjustment in the market out of whatever you want to call it, current situation, people mad, whatever, you know.
Yeah, it's definitely a new landscape that no one has ever experienced. So what you are referring to is similar to what's happening in the single-family land, where lenders are very skittish about, HFA business or first-time home buyers.
Correct. But my point is that we may not pick up the slack in the but in the short term you may, because you have so many projects already in the works. So we may have money to fund more than we would have otherwise. But at some point, whether that's 6 months from now, 9 months from now, we may see that there's not as many projects anymore because people, for whatever reason, right, they're waiting to see what happens. People are mad because they were not able to collect rent, so on and so on.
We can add it to the list, the strategic plan list.
Okay.
Great. Any other questions? Hazim, I'm sorry, I'm just noticing now the minutes that are in our program here, the board documents, looks like they're from January 30th.
That's actually correct. Because we did not.
Right.
We did not have meetings. We canceled a few meetings.
That's right. All right. All right. Well, is there a motion then to adopt the minutes from the January 30th meeting?
Tim Hodges.
George Perez, second.
Okay, it's been moved and seconded. All those in favor, say aye.
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 Aye. Aye. Any opposed? Any abstentions? Okay, the minutes pass. And could I have a motion to adjourn the Finance and Audit Committee meeting?
So move. This is George.
Been moved.
Second, Tim.
Second, Tim. All's in favor of adjournment, say aye.
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 Any opposed? Any abstentions? We're adjourned. And just a reminder, the same thing for the board meeting, to be sure that you log in as a host so that you're able to speak if you need to. I unfortunately got a last-minute call that I'm going to have to be on with my work, so I'm not going to be able to be at the board meeting. But we'll catch up with you all next month. Thank you.
Thank you.
Thank you all.